Hey guys, welcome to my channel. Today we're going to be talking about the Fed's new policy regarding the inflation rate and how this will impact you. So let's get to it. So what is inflation? I'm going to describe it in this way. In 1955, the price of a movie ticket was 73 cents. Today, it is about $9. This phenomenon is called inflation. Inflation is the increase in prices of goods and services across an economy over time. Inflation impacts every aspect of our life, from buying groceries, filling up our gas tanks, eating out, and medicine and education, and much, much more. Lately, inflation has been relatively low at around 1.6%. This means that the prices of goods and services are less expensive. So what does this mean for you as a long-term investor and your money regarding the Fed's decision? So who actually complains that the prices of goods and services are low? Do you complain that you can buy an item for less money than before? Definitely not me. So who's really gaining and benefiting from the Fed's decision to raise the inflation rate? Jerome Powell just announced that they want to keep inflation moderately higher than their 2% target rate. So they want to keep the inflation rate at 2% on average rather than 1% on average. They will be reviewing this policy every 5 years. So for example, let's say if the Fed's moderate higher target is around 3% or 4%, this means that your $100 today would be worth only $82 in just 5 years from now, because inflation would eat at the value of your dollar over time. The major benefit why the Fed is raising the inflation is to absorb the cost of debt of the federal government and their massive borrowing and spending through the stimulus packages. Inflation is going to make things more expensive for the average person. Things are already hard because the price of food and energy really hasn't gone down. In fact, it has gone up over time. Unfortunately, inflation excludes food and energy costs, which kind of distorts the true picture of real inflation because they fluctuate often. The Federal Reserve controls the fluctuations of inflation by adjusting the interest rates and the amount of money circulating in the economy. They try to keep the inflation rate at around an average of 2% so that it doesn't spiral out of control like we had during the 1970s and 80s, when inflation was actually around 14%. The important thing to understand about inflation is when demand rises really fast and supply is low, it can cause hyperinflation. Businesses then raise prices to meet the demand, and it spirals out of control into hyperinflation. Hyperinflation is a term to describe rapid, excessive, and out of control general price increases in an economy. Typically, they measure more than 50% per month. The opposite of inflation is deflation, which is the fall in cost of goods and services, which is what we have right now, and the Fed doesn't like it. This should be a good thing, but the Fed sees this as a bad thing because people aren't spending enough money in the economy. The Feds don't want people to be saving their money in the bank or under their mattress. Instead, they want people to be spending it to get the economy moving again. This is very hard to do when people are losing their jobs and companies are going bankrupt and when most of the economy is shut down due to the coronavirus. So what should you do? Definitely don't keep your money in the bank because the banks aren't paying enough interest to offset inflation. The interest rates that the banks are paying are roughly 1% if you keep it in a CD. So you want to do everything you can to invest your money in some kind of stocks or bonds that pay higher or greater than a 2% interest rate, because the inflation rate is going to be over 2% on average, possibly 3 to 4%. So you don't want your money to be decreasing in value over time due to inflation. The other thing is it's going to be pushing more people into the stock market. This means that the stock market is going to be going higher because the Feds are pushing people to invest more money and they're backing it up. But there is going to be a time in the future where they will have to start raising interest rates and people will be moving out of the stock market and it will be causing a bubble. And when that bubble bursts, it's going to be very ugly. So you need to be very careful about how you set your money up into the stock market, because things are not going to look very good whenever the interest rates are going up. But in the meantime, the interest rates are low and the stock market is going higher because the Federal Reserve is pumping money into it. They want to get people back into investing, more investing. So in the meantime, have fun, make money, but just realize that it's dangerous. Be careful with it. And this inflation is going to cause more problems down the road because it's going to be harder for the average person to save money and to make money because your value of the dollar is going to go down due to inflation. Let me know if you guys really liked this video and if you found it helpful and useful. And if you like this video, please share it with other people like yourself, so that YouTube's algorithm can spread it around with other people. Thank you for watching. I'll see you in the next video.